Welcome back, ladies and gentlemen, to another episode of the Real Estate Investing Q&A show. This is the 7th episode now that I've recorded. Still need to come up with a better name for this. I'm not 100% thrilled. Something a little bit more catchy, something a little bit more unique to me. If you have any suggestions, let me know. I'm super curious. I could use some ideas because it's on the back burner, but I'd like something different. But week in review. Today was pretty cool. We went back down to the office space, laid out everything. We're grabbing some tape. Tomorrow we're going to put it all on the floor, kind of check how everything's going to lay. But it's way bigger than we thought, so it's going to be super nice, super cool. We're probably going to have a dedicated office space area to do more recordings, podcasts, informational videos, deal review stuff, more interviews, just tons and tons of stuff. I got a lot of ideas churning in the old noggin, so hopefully we'll be able to pump some more stuff out for you guys, both on here as well as for Toro. I want to start doing some property tours with John and Don of stuff we own or stuff we're looking to buy, maybe down in some markets. We did that one mashup video from Indianapolis and Columbus, but that was me recording, not my specialty. I just did it from my iPhone, just kind of threw it together. So I want to do some more stuff because I think it's cool, it's interesting, provides a little peek behind the curtain, something that I think a lot of people would find very interesting and informative. So with that being said, we are now also in the equity raising stage for our deal in Columbus. We finished the investment summary. Took a little bit longer than we thought. John decided to take a 2-week vacation up to Lake George with his family. Well deserved, so hope he's having a good time. Should be back this week, but did delay things a little bit. We sent that out on Friday. Had some commitments already, which is always great. We had some pending people that said, hey, once we get this, we're in pending, everything's fine. So not including those people, we probably had about 5 to 10 people commit, anywhere from, $50,000 to $250,000. So really happy about that. If you're watching this video and we're one of those people, thank you very much for your trust, your commitment, and for thinking of us when you're thinking of investing. So if you do have any interest, I don't really plug it too much, but I'm going to in this video. If you do have any interest in investing passively in a multifamily deal with us, feel free to reach out to me by email, chris@tororep.com. We'll set up an intro. We'll get to know each other. If you're in the area, we'll grab some coffee, grab a drink, something like that. Just have a conversation. If you're not interested in investing at all either, please don't hesitate to reach out. I'm more than happy to jump on a quick call. If you're in the area, get together, help out in any way I can. That's what this stuff is for. But if I can help you a little bit in a one-on-one or point you in the right direction, and I have the time, more than happy to do so as well. So, while I'm always happy to meet people who want to do business with us, I'm more than happy to meet somebody and help them do it on their own as well. So the equity raise is going on. We should be closing the end of September. So we're going to be getting all that stuff together, then getting people out the legal documents, answering any questions they may have, and just going from there. So, our deals, you're going to kind of get a week-by-week update if you watch these things all the time, so you can kind of see how stuff progresses. Some of it is, kind of slow, and a lot of it is very quick. So just staying on top of stuff, getting it through, and, the time you think you have fades away really quick. But with that update done, I'm going to jump right into the first of 3 questions. This is from Instagram. It's a short one. In general, would you recommend buying a manufactured home as a rental? Now, this is a great question because there's a lot of different things that can go off on this. So manufactured homes is synonymous for mobile home park, trailer park, and quasi-similar to an RV park. RV park is the RV cars that drive in. This is not really that, so I'm going to exclude that. Mobile home parks and manufactured home parks are terrific investments. The reason being, you own the land, and the goal is to have people bring their own homes, and they just pay you lot rent. So you don't have to worry about, repairs for the units, the houses. You don't have to worry about, the electricity. You just got to make sure that the utilities get there, and then everything else they take care of. It's the same as it's not the same as that, actually. I was going to say as a condo, but that's not true at all. It's one of the only ways where that they have to take care of any of the problems that occur. So if, their door's broken, they got to fix it. They own the home, you own the land. So from that standpoint, it's great. If you're looking to buy a manufactured home, on land that you do not own to rent out, it is a fucking terrible investment. The reason being, one of the greatest appreciators of property is the land value. So if you don't even own the land, you're actually probably owning an asset that is going to lose value. As this thing goes through wear and tear and needs repairs and things updated, it's actually going to lose value. Buying a brand new manufactured home could be $50,000. A used one built in the 70s could go for $10,000. It's the same as a car. It's actually very similar to a car. A manufactured home without the land is very similar to owning a car. It's not going to appreciate in value, more likely than not, or you're going to have to pump a ton of money into it. So if you're talking about buying a manufactured home without the land, don't even fucking consider it. I don't care what the return is. It's just not even worth it, because you're just owning a depreciating asset, and that's not the point of real estate. If it is a single manufactured home and the land, it's basically the same thing as investing in a single family home. The reason being, it's just a different style of home. It's like renting out a bungalow or a beach house or a single family home or a duplex or a manufactured home, one piece of land. It's just a different style of housing. So it's the same. You may be able to buy it for way cheaper, the land and the home, because the homes are prefab. They're made in a factory and shipped out. You may be able to get that for cheaper. So it may produce better cash flow if, you do the math and things of that nature. But it's essentially the same thing. I don't know how it really stacks up to in comparison to other assets in terms of upkeep and, keeping on top of repairs, and from a home ownership standpoint, from a insurance standpoint, from a mortgage standpoint. I can't really speak too much about that, because whenever we've looked at manufactured homes or mobile home parks, one, I'm not the primary person doing it, so I am about 50% of the knowledge that John has, who runs it primarily. But we always look to try to buy parks with multiple lots and primarily just the land. So it's not really something we've looked into or considered. And anytime there is park-owned homes, our goal is to sell that to somebody and just continue to rent out the land. So manufactured home, park with the land, great. Manufactured home with no land, terrible. Manufactured home as a single with land, basically the same as any other asset. You just got to do the math and figure out if it works for you. Next question. It's short, but can you point me in the best direction for my first investment? The reason I chose this question is I think a lot of people hear about real estate, and they hear about, there's the famous quote, 80, 90% of millionaires made their money in real estate or own real estate or whatever the fuck it is. Most overused quote. It's fucking tired of hearing it, to be perfectly honest. But people hear that and they want to get into real estate, but they don't know how to start typically. And no offense to anybody that asked me this question or the person that did ask me this question. Typically, the person that is asking this question has only just started to learn about it and has not put the necessary time in to do the research for all the different ways that people can invest in real estate, make money in real estate, et cetera, et cetera. So when I get this question, my almost singular piece of advice is to spend the next couple months, couple weeks, and really learn about all the different ways that somebody can get involved with real estate. I say go out and actually physically write down 20 different ways you can invest in real estate and the different asset classes and the different avenues, because just in multifamily alone, there's probably, off the top of my head, 4 or 5 different ways. You can do it as a development. You can do it as existing multifamily. You could do it as a redevelopment. You could do the debt side of it. You could do, the passive investing side as equity. You could do it as preferred equity. How else could you do? You could buy underperforming notes. So instead of issuing a new mortgage, you buy, a issued note or mortgage that is already going on, and for whatever reason they're missing payments or not paying as much, and you can buy that for, a discounted rate and try to get that note performing again and work out a payment structure or go through the foreclosure process and then own the property outright. So And that's just, for multifamily. Single family and other things, there's tax auctions. That's for any asset, really. There's investing in single family. There's investing in, as a rental. There's investing in single family as a flip. There's investing in notes on single family. There's dozens and dozens and dozens of ways. If I sat down and listed them all, I could probably do a 30-minute video on just different ways to get invested. And maybe that's a video I'll actually do, is come up with as many different ways as I can and give a brief overview, but that's for another day. Actually, if you're watching this and you think that's a good idea, let me know. I'm curious. But if you're just starting to learn, or you're thinking about asking somebody the question, how should I get started? You've got to understand the question. You don't understand the questions to even ask to figure out which way to get started. You need to understand the pros and cons of a ton of different ways to get started to figure out which one best suits you personally. The reason I say this is everybody could have very different investment goals. If I have, $5,000 to my name, or I have $50 million to my name, I'm going to invest in very different strategies, most likely, because I'm going to have different investment goals. If I already have $50 million, I'm pretty much set for life, pending I don't lose that money and inflation doesn't go fucking haywire. I'm going to be much more concerned with capital preservation than I am if I only have $5,000, where I'm trying to take that money and maybe I'm trying to maximize as much as I can and start to grow that nest egg, and then eventually start to get more conservative. If I'm 70 years old and I'm in retirement, again, I'm probably way more concerned about capital preservation and cash flow, right, supporting my lifestyle month to month, than I am probably in, risky investments with tons of appreciation. Just as generalities. So that's, the other avenue. There's also different things about, the capital required to get involved. To buy a piece of land and try to flip it, you could buy land for 50, 100, 200, 500 bucks and try to flip it. Now, there might be some cost to find that, but if you just bought it on, let's say you just went on MLS and you found a piece of land, you're like, fuck, I think it's worth double that. You could easily just go on, buy it, and try to flip it, and it would cost you whatever the cost of land is plus closing costs, legal, stuff like that. So very cheap to get into. But if you wanted to own your own 200-unit property in a downtown area, let's call it Manhattan, it's going to cost you tens of millions of dollars, probably hundreds of millions of dollars, if we're being 100% honest. So that's going to cost me way more money if I don't want partners. I don't want to raise money. I want to do it myself, and that's what I want to own. Totally different capital requirement. If I have $5,000 and I just want to get my foot in the door on something that's a little bit more liquid, maybe I'll look at a REIT. I know that's not a traditional or true real estate investment, but it is a way to get invested in real estate. You may not own real estate directly, but you are receiving returns based on investing in real estate. So there's tons of different ways to get involved, and you just got to really understand what your goals and desires are for getting into real estate, and then backing into the best couple of avenues to go about it. And also knowing that, the only way you're really going to know for sure is to try. When I first got started in real estate, I spent 6, 7, 8 months trying to flip single-family homes in Long Island. Failed. Didn't buy a single house. Didn't put one under contract. Didn't flip a home at all. So spent time and money on that. Pivoted, tried to get into buying tax deeds in Philadelphia at the auction, and hated that from the moment we first tried it. Took me way shorter. Took one trip to realize it wasn't for us. It was just in rougher areas than I wanted to be in. It was large time commitments on the weekend, and my mom and my cousin, who were my partners at the time, had other time requirements that made them not want to do it, as well as I didn't want to do it. I just was 24 at the time. I didn't want to spend all my weekends down in Philadelphia. I was still going out, having a good time with my friends. So knowing what your goals are, we knew our goals and our why and what we wanted to get out of it, and we knew very quickly tax deeds wasn't for us. Finally, we moved on to multifamily, and it clicked. It was, tax beneficial. It was more long-term focus, less risky, and just made sense for us from kind of our goals and desires. So it might take you a couple different tries before you find the one that's really right and actually makes sense in your area. I would still flip homes. I just think the margins are so slim on Long Island and New York that it's not worth my time and energy. I also would flip land in these other areas, but the total dollars, the ceiling on land flipping is much lower than with the multifamily syndication that we do right now. We can go out and buy, a $25 million building, a $39 million portfolio like we did in Jacksonville a couple months back. For me to get to $39 million in purchases on land flipping would take forever. I don't even know. It'd be silly. Now, obviously, slightly different because, the percent you're trying to make on a flip versus the percent but you get what I'm trying to say. So just knowing what you want to achieve and understanding the different avenues of real estate investment and if they can help you achieve those goals is going to get you further in that path. And then you can start to go to people and ask, hey, what are some of the downsides of flipping single-family homes in a high-income area? Questions like that are significantly easier for me to answer and help other people understand whether it would be a right fit for them or not. But that's it, basically. On to the third question and the last question. Hey, man, just saw your last post about house hacking. That's exactly how I started, and it's helped so much over the past couple years. I noticed you're buying some larger commercial properties. Are you doing joint ventures, JVs, on any of these larger ones? And if so, how much capital is required for some of them? I'm looking to possibly sell one of my poor-performing duplexes to raise capital and reinvest. So the way we are buying the properties that we are, we target 70, 80, 100, 200, 300 unit properties in the Southeast and the Midwest. And the way we are acquiring these properties is through a avenue called syndication. And syndication is basically a fancy term or just a term for raising money from investors for the equity portion of the property. So on every property we buy, we will go out and secure debt anywhere from 60% to 80% of the cost of the total property, and then the rest. So that includes the down payment, any potential renovation costs, any closing costs, any reserve, and then our fee gets paid through the equity portion. And the reason we raise equity from other people is we only have a finite amount of money. And for us to be able to spread that money into other properties and spread out risk and diversify, we bring in partners, in investors, limited partners, sometimes general partners, but mostly limited partners, to go out and be able to acquire more than what our ceiling is by ourselves. So if we're 100% of the equity, maybe we have, just call it $10 million, arbitrary number. If it's, if 10 million is, 30% of the property's value, that puts you at roughly $30 million worth of properties, give or take, just high level math. That's really like a third, so 33%. But if we can take that $10 million and we say, hey, we're going to invest 10% of the equity in every property. Well, now we have $100 million to go out and place into properties. So now that ups it to we're able to buy $300 million worth of properties. That could be, let's say every deal was a $10 million purchase. If by ourselves we could only do $30 million, that would be 3 properties. Now we could go out and buy 30 properties at $300 million, and we can spread our investments across different assets in different markets if we desire, in different types of assets. And it's just a better way to diversify our risk, as well as our investors get the benefit of the diversity, and they also get the benefit of us, our track record, our experience, our operational history. And the way it works is, we take some small fees, and then we also have a waterfall or profit sharing structure on the back end. So basically, as we continue to perform better and hit higher return metrics, we take slightly more of the pie. I can do a whole nother video on that. I've actually done one on my Instagram, so if you want to understand that, go check it out. It's something about waterfall structure or profit sharing. Can explain it more, but we do multifamily syndication. That's how we do, I think, all of our deals. I'm trying to think if there's any we haven't. Technically, one, I guess you can consider a joint venture. There's only a couple partners, but it's mostly, 95% of our deals are syndication, where we're raising anywhere from 90% to 50% of the equity from investors and running the deal on their behalf. So if you were looking to get into commercial properties, because the second part of that question is how much capital is required for some of them, I almost don't want to answer because that's such a tough question. It depends on the size, the asset class, the location, the type of property, some other stuff, I'm sure. But it could be, you could buy a commercial property for $500,000 and you could put down, $100 and go do it. So, if you have 50, you have to go raise another 50. Or you could go buy, a $300 million property. I know that's obviously not what he's referring to, but it's super subjective. So, there are costs involved for setting these things up and closing properties. And if properties don't close, sorry, the sun's in my eye, I'm trying to get out of it. There's other costs involved than just your investment. We've walked on deals that cost us money out of our pocket, $10,000, $20,000, $50,000. One deal we did, we actually walked on our deposit of $500,000 because as we got through due diligence, we realized that it was not a property we wanted to invest in. We were better off eating the $500,000 as a company than continuing with that and putting investors into a deal that we didn't think was up to our standards. Whether we should have caught it beforehand or not, that's on us, but that's why we ate that cost. So, there's a lot of costs involved besides just, hey, what am I going to invest in this deal, that a lot of people don't tell you about. So I hesitate to do this, but if you were going to go out and you were looking to syndicate, $5 to $15 million deals, expect 5 to 10% of the equity you're going to need, as well as $25,000 to $50,000 in costs you may have to incur if you decide to walk on a deal after putting it under contract. That's not including any costs for, setting up your company, going on trips, expenses to, run a website and social media and other things involved. So just for the property alone, you could end up eating $25,000 to $50,000 if you walk. Now, obviously, if you close, those costs get reimbursed as a closing cost, but you take the risk as the general partner, the syndicator, the sponsor, the operator, whatever term you want to use. You take the risk that if you start to incur these debts to different people, legal, lender, property management, vendors that you bring out to check over the property, accountants, entity opening, et cetera, travel costs, if you're out of state, these are things that you're going to have to pay whether that deal closes or not. Now, if you're lucky enough to work with nice people, maybe they cut you a little break, but these are things that are going to cost you money if you do not close that property. So really talk to someone, make sure you understand there's tons of resources out there that can break it down further on specific deals and what things cost and money you may have to eat. But it's not as straightforward as some people think. It's not just the down payment. There are additional costs involved. But I'm going to leave that question there. That's going to be it for tonight. I'm trying to stay out of the sun. It's annoying the shit out of me. I don't know. It's just poking through the blinds over there. But that's it. If you haven't already, if you've watched this video or some other videos, it'd be awesome if you could subscribe. Just makes me feel better, knows I'm doing something right. If you could like this video as well, if it's something you thought was helpful, helped you in some way, shape, or form. If you want to have a question answered in a future episode, drop it in the comments below. shoot me an email, chris@torarep.com. Hit me up on Instagram, Grenzig, CRE, and just shoot me your question. If I like it or I think it's helpful for other people, I will use it. If I don't like it, I will tell you why I don't like it, and maybe ask you to clarify something so that it is usable. But I'm always looking for questions. I appreciate people that are asking me questions, giving me stuff to use. Sometimes I'll look on Bigger Pockets for stuff if I think there's a good question there that would be beneficial to other people. So, yeah, that's really it. Thanks for watching, and stay tuned next week for next week's episode. Thanks.